Welcome back, everyone. In this video, I'm going to be going over a topic I know a lot of dividend investors love, and that is monthly dividend ETFs. And more specifically, I am going to be covering DIVO. Now, DIVO or DIVO is the Amplify CWP Enhanced Dividend Income ETF, and this is a great ETF. So I thought it was about time to give this ETF its own video. But first, kind of moving back a little bit, because I know Amplify isn't really a well-known asset manager. It's not like JP Morgan Chase. It's not like Invesco, it's not like BlackRock. So a little bit about the company. They do offer a variety of ETFs through Amplify ETFs, and this does seem like an offshoot of Amplify Investments. The company is based out of Illinois, and based on their LinkedIn profile, they have between 11 to 50 employees. So it's a relatively small company in the asset management space compared to some of those bigger asset managers that I previously mentioned, but pretty much they are an asset manager and a registered investment advisor, and the firm was founded by Christian Magoon, an investment veteran who has launched over 60 ETFs in the United States. And the ETF itself is rather large for such a small company controlling it. The current net assets is currently at about $3.8 billion in assets under management, which is a pretty good size, all things considered. And the expense ratio of this ETF, many may consider a bit high at 0.56%, but it does offer some pretty good benefits. Now, as the fund page itself says, DIVO is an actively managed ETF of high-quality, large-cap companies with a history of dividend growth along with a tactical covered call strategy on individual stocks. DIVO is strategically designed to offer high levels of total return on a risk-adjusted basis. So the fund page itself proposes a question, why invest in DIVO? And it says income potential. It is comprised of high-quality dividend-oriented stocks along with covered calls on those individual stocks. So basically, you're receiving income both from dividends and also the premium received from selling those covered calls on individual stocks. It is actively managed. This allows the portfolio manager to identify opportunities and risks and act on those decisions in real time, and it also seeks to lower volatility. Dividend and option income may provide lower share price volatility versus the overall market during times of broad-based market declines. When it comes to security selection, you are going to find that this ETF stands out as it is not as diversified as many other ETFs out there. DIVO consists of 20 to 25 stocks, which are screened and adjusted according to attributes including market cap, management track record, earnings, cash flow, and return on equity. So basically, they are buying a focused amount of companies and then also screening those companies based on their qualities, which includes market cap, management track record, and so on. So think tightly narrowed group of companies and then also selected based on good qualities. Now, that doesn't mean that the ETF itself isn't diversified. I believe 20 to 25 companies are a decent diversification across the board. And then on top of that, the ETF is diversified pretty well across industries. The largest industries is going to be financials, followed by information technology, healthcare, consumer discretionary, industrials, and then below 10, you have things like consumer staples, communication services, energy, and materials. So just like as the initial fund page said, the total number of equity holdings is currently at 24, and the top 10 holdings are going to be a list of pretty well-known, large market cap companies. So you're going to see Caterpillar, United Health Group, Home Depot, Apple, Visa, Microsoft, Procter & Gamble, Goldman Sachs Group, Amgen, and JP Morgan Chase. And I think just by looking at this top 10 holdings and also the industry diversification, you are going to see that this ETF does not have a basis regarding the S&P 500. In other words, this does not track the S&P 500 or the overall market to begin with. So you are going to have diversification away from that if that is what you are looking for. Now, looking at the S&P 500 or VOO, which is an ETF that tracks the S&P 500, you do see that the S&P 500 has sectors that are much more heavily weighted toward information technology and not so much weighted toward the industries that DIVO is weighted on. such as financials, among other industries here. So again, you are going to move away from necessarily the industry classifications of just the S&P 500 when you own this ETF. I'm getting into what you're all here for, and that is the dividend. The current dividend yield based on the NASDAQ site is currently at 5.1%, which is quite a bit high of a yield for most dividend ETFs, but this is still going to be less of a yield than things like JEP-E or JEP-Q or SPYI or those really high dividend yield ETFs. Now, however, this ETF does make up in capital appreciation, and we will get to that shortly. But about its dividend, you will receive a dividend on the payment date, which is about the last day every single month. Now, it might be a little bit off, maybe the second to last or third to last day, but it is going to be falling within the last 3 days of every single month, which is great for income investors because you can kind of forecast your bills around it. Now, I also want to make a note here in the cash amount column. You do see that this dividend ETF, unlike a lot of other dividend ETFs, does grow slightly in amounts over time, but you will see that during periods of high volatility, this ETF will still pay out more. So this isn't necessarily a dividend growth ETF, but steadily over time, it does seem to slowly grow over the long term, although not at a high rate like SCHD or something like VIG or DGRO. This is going to be an income ETF where most of that income comes from the premium of selling those covered calls. So a little about capital appreciation. Now, I in part love this ETF because it does what a lot of other covered call ETFs do not do, and that is the underlying investment grows in principal over time. You do see a lot of covered call ETFs not grow as much in principal because of their covered call strategy. Now, DIVO, on the other hand, definitely does offer not only a pretty high dividend, but also capital appreciation. You see over the previous 1 year that this ETF is up just in price of 11.02%. Now, if we look at another pretty well-known covered call ETF, which is an ETF I actually own myself, which is JEP-E, the JP Morgan Equity Premium Income ETF, you notice that it is only up about 4%. So based on just price appreciation, DIVO no doubt destroyed this ETF. Speaking of long-term performance, this ETF did perform very well as well. And you see the since inception price right here increase by 11.89% annually. So that is a great annualized return. And if we look at the S&P 500 return, during that time, it is 14.51%. And of course, with a covered call ETF, you're not going to expect the price to increase in line with the S&P 500. Again, covered call ETFs are designed to give investors income and also provide a little bit of downside protection as well. So overall, solid for an ETF that only trailed the S&P 500 by about 3% annually. And you see the buy right index, which is an index which kind of tracks a covered call strategy on the S&P 500 itself. It outperformed that too by a large margin by about 4.5%. So all in all, this offers great annualized return with those dividends as well. Kind of just getting into where those covered calls fall into. This is the entire list of holdings that this ETF has. As you could see, it has all of the companies here, and I would encourage you, if you want to see all of the companies it currently holds, you can kind of just slow down the video or pause this video. But these are all of the companies this ETF holds. And if you notice down at the bottom here, you will see where this ETF holds these covered calls. So right now, it doesn't hold covered calls on every single one of these stocks. Remember, it is a tactical covered call strategy, so the fund managers will only sell a covered call if they believe it is beneficial during that specific time. So right now, for example, it looks like they have a covered call on Visa. It looks like they have one on Chevron, JP Morgan Chase, American Express, and Goldman Sachs, and a couple of others. So again, this ETF doesn't sell covered calls on all of its holdings at the same time. It implements a tactical covered call strategy, which tends to allow these underlying companies to grow as well, which definitely helps that return out as this ETF progresses. Now, to reiterate and summarize what this ETF does, and now I think the fund page does a very good summary of that. So DIVO is managed with a strong emphasis on owning high quality, large cap companies with historical dividend and earnings growth. The sector allocation of DIVO is relatively balanced among the traditional 10 S&P sectors, with CWP, the asset manager, determining which sectors to over or underweight based on various factors. The ETF consists of 20 to 25 stocks, which are screened and adjusted according to attributes including market cap, management track record, earnings, cash flow, and return on equity. And then the fund managers also use a tactical covered call writing strategy on individual stocks on a tactical basis. So all of this we pretty much went over in the long form. Let me know in the comments section down below what you think of the Amplify CWP Enhanced Dividend ETF. Me personally, I do think it is a wonderful covered call ETF compared to other covered call ETFs out there. Now, some people may not invest in this ETF because of its covered call strategy. Its dividend is not high enough, and also the ETF does charge a pretty high expense ratio compared to other covered call ETFs out there. Please, if you did enjoy this content, give this video a like to get this content out there to a wider audience. And if you did watch this far, please consider subscribing for future content, and I will see you all in the next video.